There's been a lot of chop in the market over the last few weeks. Traders are getting frustrated. They don't know if it's going to bounce. They don't know if we're going to make another leg lower here. And it really leaves us in limbo wondering, okay, what is this market going to do? And in the meantime, it's chopping up people in their positions because one day they get long, the market sells off. The next day they get short, the market rallies. So really, what are we looking at going forward here? Are we going to break out of this funk, this sideways price action that doesn't really seem to lean one way or the other? Are we going to bounce, or are we going to keep selling off? I'm going to go over all the charts today. I'm going to give you my thoughts on where I see this market going, what I'm hoping to get out of it in the days and weeks ahead, and how I'm going to approach it as a result. So before I get into that, make sure you like and subscribe. That means clicking on that subscribe button, liking the video, and making sure that little bell thingamajig is clicked so that you can get all of the notifications of whenever I do a new video or live stream. And if you're really into this channel, click the join button down below and you can sign up to become members of the YouTube channel. You're going to get all of my stock market research each and every day to you. That's going to be multiple videos sent your way. So really a cool value and worth checking out. Now, we're in the midst of earnings season. We're in the very beginning of it. So far, you've had the banks. They performed pretty well. You've had Netflix, it had a pretty good earnings report. Then you get Tesla. Tesla sells off, at least in the evening. They beat on earnings, but they miss on revenue. But I think there's a lot of jitters as it pertains to next week and the week thereafter. That's where all of your other big tech stocks like Apple and Amazon and Meta and Google and Microsoft, they'll all be reporting. You also have a lot of your semiconductor companies reporting, and that's going to have a huge impact because that's probably where most of your stocks are the most overvalued at. And so if they miss, there's going to be this huge contraction, not only in the earnings multiple, but it's going to pull down the whole market as a result, especially if one of the big guys miss, like Apple, Amazon, Microsoft, or Google. If those miss, they can drag a whole market down with it. Now, if they report good earnings, don't assume that the market's going to do really good. You got to look at what we just saw with Netflix. Netflix had a really big earnings beat. The market initially rallied, but oftentimes when these big tech stocks beat, they may continue to rally, but the rest of the market doesn't join it. It almost like it sucks the air out of the rest of the market when they have a big beat. So don't assume just because the big tech stocks, if they are to beat, that you're going to have a huge market rally as a result. Now let's go ahead and look at the SPY chart here, because I do think it's worth mentioning what we are looking at as it pertains to this chop. So if you go back to March and you go back to June and then you compare it to what we're dealing with right now, it's a lot of chop. So for instance, you have this nasty chop that we saw back in February and March. And then after that, you had also a pretty rough patch there in May, but a much bigger rough patch of choppiness and indecision by the market in June that carried on into mid-July. Finally, what you have going on right now is nothing short of that. I mean, if you go back about to mid-September, we've not really gone anywhere. We've traded sideways, we've gone up, we've gone down, we've gone back up again and come back down to where everybody's questioning whether or not we're actually at a near-term bottom. But ultimately, what happened? We broke out of this funk. While there was a lot of choppiness that started in January, you could probably even condense it further down to just February and March. But once it broke out, it made a significant run. You had a little bit of a breakout here in May, but then you had the big rally that started in mid-July and carried over into August. And that was a significant bounce for the market. Now, we're in a similar situation, even similar price action. What you want to see is, can we break out of this box? Can we start to push higher? Then you start to look at, okay, can we get back above the highs from September 12th? That was constitute a significant higher high. Now, all it has to do at this point is get back above the highs from October and you have yourself a higher high there. But every time you can break through one of these previous highs, that is a significant level of resistance that we're talking about here. But what you want to be careful of is that you have a lot of declining levels of resistance. And on SPY, you have the big one that goes all the way back to January this year. And it runs in conjunction with the 200-day moving average. So the big test for this market, if it's truly going to turn the corner, put a bottom in now, and start to make a run at a new bull market, then it needs to break this declining trend line. That's the only way around it. But now there's also other levels of resistance in the more near term that we need to be concerned with. The first one is this declining trend line off of the August highs. And then you have an even, that level has to break in order to get the wheels turning for a potential move to the much bigger declining trend line that we last tested in August. Now, what about the weekly chart? And I think the weekly chart is something that we really have to be cognizant of, because here you have some major bounces that have taken place off of the 200-week moving average. And where are we at right now from a price standpoint? We are sitting on this 200-week moving average. And we've yet to get a significant bounce. Even in 2008, where we actually broke the 200-week moving average, we still saw an initial rally take place. So when you're looking at it here, This is the 2008 self. We had an initial rally here that lasted for a couple weeks, and then we had another one on the retest that lasted for more than a month. In 2000, it was the same exact story. Now, we didn't get a significant bounce back in 2000. However, in the Qs, you did see a significant bounce off of this 200-week average that lasted a couple weeks. So looking at the Qs, we're actually trading below it, but we're not trading significantly below this 200-week average, and it's close enough to where we could still see a significant bounce off of this moving average, just like what we saw in times past, where we bounced in 2015 and again in 2020. Got pretty close to 2018, but no cigar. The point behind this is the 200-week MA is very significant at this point. The bulls need to step in here and try to rally off of that level to be able to give some relief to the markets. And if you're looking to short the market, that kind of a dead cat bounce off of the 200-week moving average would provide a really good entry into new short positions. Now let's look at the daily of the Qs. A very good downtrend going back to the August highs. This has been the new leg lower following that monster rally from July and August. This downtrend has held up perfectly so far. In fact, we've tested it twice so far, and we've yet to be able to break through it either time. So in order for me to get more bullish on the NASDAQ and in tech and specifically, this downtrend on the Qs needs to break to the upside. You need to see price push through it at around 276. If it can get through that 276 level, it sets up for a world of opportunity, especially if it can get through this 281 level as well. There's some resistance there from a price level standpoint that it needs to break through. Now, still, the most inspiring chart here is IWM. Guys, this thing still has a double bottom in place and still is holding those June lows remarkably well. That is not something that you're seeing in SPY or in the Qs, this incredible test and hold of the June lows. And you have a nice basing pattern that's also setting up to where if it can get above this purple line, it would confirm the double bottom. Now, we almost got there on Tuesday, but it couldn't hold those gains after the nice gap higher. Instead, it pulled back, but it also provides perhaps a really nice opportunity to get long on that break, confirming the double bottom with a stop loss below today's lows. But any kind of a rally that you see in the Russell 2000, you want to be mindful of the declining trend line off of the November highs of 2021. Plus, there's also another level of resistance too to be mindful of, and that comes off of the resistance that goes back to the beginning of this year, where you've seen multiple tests and rejections at this particular level. Now, what makes this so interesting is that these two levels are starting to converge. So if you start seeing these two levels converge and you have price right there near it, there's a good chance that price action will struggle to break through it. Now, a couple more charts I want you guys to look at. VIX, here's the first one. We're not seeing much of a breakdown in this, and we've been hovering around this 33, 34 level for the past few weeks. And that's concerning because there's been a lot of market reversals at this level, but you have yet to see a real strong reversal as of yet that sends it back down into the lower 20s like we usually see. And it has a really nice trend line that still has not broken. In fact, it's testing it right now, but it is yet to break the rising trend line. So if we're at a point of capitulation in this market, if we're at the point to where everything's just going to wash out here, then I would expect that we'll blow right through this resistance level, this purple line here, and push up into the 40s and maybe even the 50s. You also want to keep your eye on the 10-year Treasury yield. And this is at its most recent highs. It's broken above the highs that we saw in September and is now above 4.1%. Big move today, and a big part of the reason why the market struggled as much as it did today. Finally, you've got the dollar. This is UUP. This is the Invesco Dollar Index Bullish Fund. You got a triangle pattern that resembles a continuation triangle, and those tend to break to the upside and continue its existing trend. In this case, it would be higher. So you got this triangle pattern here that is formed. It's trying to break out of it. I would be watching a move back above 30.50 to confirm the pattern. And then if that happens, there's plenty of reason to get a little bit more concerned about this market, that maybe we are at a capitulation. But until that happens, until we really start seeing the most recent lows get taken out, understand that we are oversold, that there is some technical levels, there's some support underneath with the 200-week moving average that you would expect that the market would try to make some attempt to bounce off of. You're also in a very choppy market right now, and you want to remember that when the market is being accommodated by the Fed, that means the policy that the Federal Reserve is putting forth is very accommodative, where they're lowering interest rates, not raising them, when they're easing and not tapering. That's going to create a lot of your V-shaped bottoms. That's what we've become used to over the last 14 years. But when they're not accommodating, when they're tapering and not easing, and when they're hiking rates and not lowering them, then you're going to start seeing more of those U-shaped bottoms, even if they're just temporary bottoms that give you an opportunity to profit from a dead cat bounce. Now, my opinion at this point in time is I'm still looking for that bounce. We have yet to really see a significant bounce like what we saw in July and August. I think that could still happen. I think the 200-week moving average has a good look to it. I think it's trying to hold that level on the SPY, and it could set up for a nice, decent move up to the upside as long as the earnings don't completely fall apart for the overall market. But you want to be mindful of the fact that the yields are still going up, that the dollar is still consolidating at its highs, and that the VIX isn't really falling apart yet. So while I have an opinion about, yeah, I think we're going higher, I have to be cognizant of the fact that I may not be right on that, and that I have to be ready to adjust my trading strategy as a result. Right now, I'm 100% cash. I'm waiting for the market to give me that opportunity to get long from a swing trading standpoint. If you enjoyed this video, I'd encourage you to like and subscribe like I mentioned earlier in this video. Also, click the join button down below and become a member of my YouTube channel where you can get all my stock market research each and every day, including some really awesome videos that are made daily. And tell me down in the comments below, what do you think the big tech earnings are going to look like this time around? And how do you think the market's going to respond? Thank you guys, and God bless.